This is part 2 of the presentation for Module 2 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will cover how the four financial statements are linked with each other and across time. As we have seen previously, the financial statements are linked to each other. Understanding these linkages gives managers as well as external financial statement users a keener ability to assess the impact transactions have on the financial statements. Every transaction has at least two impacts, and many have more than two. For example, the cash sale of inventory affects cash and inventory on the balance sheet and revenue and cost of goods sold on the income statement. This slide illustrates the linkage among the four financial statements. As we noted in the previous presentation, the income statement, statement of stockholders' equity, and the cash flow statement provide the links between the beginning balance sheet amounts and the ending balance sheet amounts. In this learning objective, we will explain the steps in the accounting cycle and apply the financial statement effects template to analyze accounting transactions. This slide shows the four-step accounting cycle. First, transactions must be recorded. Each transaction is the result of an external or internal transaction or event, such as a sale to a customer or the payment of wages to employees. Second, accounting adjustments are made to recognize a number of events that have occurred but have not yet been recorded. These might include the recognition of wage expense and the related wages payable for those employees who have earned wages but have not yet been paid, or of depreciation expense for building and equipment. Third is to prepare or construct the financial statements. Fourth is to close the books in anticipation of the start of a new accounting cycle. This slide illustrates the financial statement effects template that will be used throughout the textbook to capture the effects of various transactions on the financial statements. The template differentiates between cash and non-cash assets so as to identify the cash effects of transactions. Likewise, equity is separated into the contributed and earned capital components. Finally, income statement effects are separated into revenues, expenses, and net income. This template provides a convenient means to represent relatively complex financial accounting transactions and events in a simple, concise manner for both analysis and interpretation. T accounts are also useful for analyzing transactions, and all transactions are recorded in the accounting records using journal entries. Throughout the textbook, the template, T accounts, and journal entries will be used to illustrate and explain the effects of transactions on the accounts. In this learning objective, we will prepare and explain accounting adjustments and their effects on the financial statements. As we have explained previously, recognizing revenue when products and services are delivered at an amount expected to be received and recording expenses when incurred are cornerstones of accrual accounting, which is required by GAAP. For example, employees may have earned wages during the accounting period that have not yet been paid. If we fail to make an adjusting entry to record these wages, then wages payable, a liability, would be understated as well as wages expense, which would mean that net income would be overstated. Companies must make adjusting entries at the end of each accounting period prior to preparing the financial statements so that net income, as well as the assets and liabilities, are correct for the period. This slide illustrates the four types of accounting adjustments. First, we have deferrals. Deferrals occur when we receive or pay cash prior to the revenue or expense being recorded. In these cases, we need to make entries to adjust the asset and liability accounts related to the deferrals and recognize the associated revenues or expenses in adjusting entries. Examples of deferrals include prepaid insurance and unearned revenue. We also have accruals. Accruals occur when we record revenues and expenses before we receive or pay cash. In these cases, we need to make entries to recognize the associated revenues and expenses, and record the related assets and liabilities. Examples of accruals include interest revenue and wage expense. To illustrate recording a deferred expense and the associated adjusting entry, we will look at a prepaid expense. Suppose that Apple was required to pay MTV $200 in advance for advertising expenses before the advertising was provided. To record the original payment, Apple would credit cash for $200 and debit prepaid advertising for the same amount. At the end of the period, Apple would record an adjusting entry for the advertising expense that was provided by MTV during the period by crediting prepaid advertising for $50 and debiting advertising expense, which has the effect ultimately of decreasing retained earnings, which is part of earned capital. The next entry is an example of an unearned or deferred revenue. In this case, we assume that Apple receives $400 cash from a customer as advance payment on a multi-unit iPod sale to be delivered next month. Apple must record cash received on its balance sheet, but cannot recognize revenue from the order until earned, which is generally when the iPod is delivered to the customer. To record the receipt of cash, Apple would debit cash for $400 and credit unearned revenue, a liability, for $400. When the iPod is delivered the next month, Apple would recognize the revenue by recording a debit to unearned revenue and a credit to revenue for $400. Apple would also debit cost of goods sold and credit inventory for the cost of the iPod, $150. The effects of the revenue of $400 and cost of goods sold of $150 would ultimately be recorded in retained earnings, part of earned capital. To illustrate an accrued expense, we will assume that Apple staff earned $100 of sales commission this period that will not be paid until the next period. The sales staff earned the wages as they made the sales in this period. Therefore, under the matching principle, the expense should be recorded in the same period as the sales revenue. To accrue the expense, we would debit wages expense for $100 and credit wages payable, a liability, for $100. The wage expense would ultimately decrease retained earnings by $100. When the wages are paid in the next period, we would debit wages payable and credit cash for $100. Last, we will look at an accrued revenue. In this case, we assume that Apple delivers iPods to a customer in Boston, Massachusetts, who will pay next quarter. The sales price for these units is $500 and the cost is $400. Since Apple has completed the revenue earning process with this sale, we will accrue the revenue from the Boston customer even though Apple received no cash. To do this, we will debit accounts receivable and credit sales revenue for $500. We will also debit cost of goods sold and credit inventory for the cost of $400. The $500 sales revenue and $400 cost of goods sold will flow from the income statement to retained earnings, which is part of earned capital. In this learning objective, we will cover the preparation of the financial statements from the accounting records. After all of the transactions and adjustments have been recorded, then the accounts are summed to obtain the ending balances. A trial balance is normally ran to make sure that the accounts are in balance both before and after the adjusting entries. Next, the financial statements are prepared in the order shown in this slide. The net income from the income statement is needed for retained earnings in the statement of stockholders' equity. The statement of stockholders' equity provides the ending capital balances for the balance sheet, and the statement of cash flows uses information from both the income statement and the balance sheet. Also, the ending cash balance in the statement of cash flows should equal the cash in the balance sheet. This slide shows Apple's income statement, which was prepared from the information in the financial statement effects template in Exhibit 211 on page 225 of your text. The net income amount will be used to update retained earnings for the period. After adding the net income to the beginning retained earnings balance, we subtract dividends and common stock repurchased and retired, as well as other adjustments to obtain the ending retained earnings. The net income is also used to complete the statement of stockholders' equity, which shows the changes in all of the equity accounts from the beginning to the end of the period. Apple's statement of stockholders' equity was prepared using the information from the financial statement effects template in Exhibit 211 on page 225 of your text. In your textbook, you can find the balance sheet accounts for Apple that are shown in the financial statement effects template in Exhibit 211 on page 225. The balance sheet accounts are never closed, which is why they are referred to as permanent accounts. In this learning objective, we will explain the closing of the temporary accounts. The closing process, or closing the books as it is called, refers to the zeroing out of the temporary accounts by transferring their ending balances to retained earnings. Income statement accounts, revenues and expenses, and the dividend account are temporary accounts because their balances are zero at the start of each accounting period, so that only the current period's activities are included. As we stated previously, the balance sheet accounts are never closed. We can use either the financial statement effects template or T accounts to illustrate the closing process. In the financial effects template that is used in the text, retained earnings is updated each time that an entry is made. In practice, retained earnings is not updated with net income until after the temporary accounts have been closed. The closing process occurs at the end of each reporting period. This slide shows the accounting equation in the form of T accounts. When T accounts are used to analyze transactions, debits are recorded on the left and credits on the right for all accounts. Since asset and expense accounts are increased by debits and decreased by credits, and revenues, liabilities, and equity accounts are the opposite, the accounting equation is maintained when journal entry amounts are entered into the T accounts and the balances are determined. The first step in the closing process is to close the revenue accounts. In this slide, we can see the closing of the sales accounts by debiting sales and crediting retained earnings. The sales account will now have a zero balance and be ready to begin accumulating costs during the next reporting period. Ordinarily, companies do not close their accounts directly to retained earnings, but instead use a temporary account, usually called income summary, to accumulate all of the debits and credits from the revenue and expense accounts, and then the income summary account balance, which equals net income or net loss, is closed to retained earnings. This slide shows the closing of expense accounts to retained earnings. Since the normal account balance for an expense account is a debit, retained earnings, or more likely income summary, is debited and the expense accounts are all credited to reduce them to zero. The expense accounts are then ready to start accumulating amounts during the next reporting period. Dividends are closed by debiting retained earnings and crediting dividends. Dividends will now have a zero balance and be ready to accumulate amounts during the next reporting period. In this learning objective, we will learn how to locate and use additional financial information from public sources. As we previously mentioned, United States public companies are required to file Forms 10K and 10Q with the SEC, but there are also other forms that are required to be filed with the SEC. Form 20F is required to be filed by non-U.S. companies whose securities are publicly traded in the United States. These foreign companies must furnish within 4 months after the end of their fiscal year the same audited financial statements required on Form 10K prepared according to U.S. GAAP or IFRS. If the company uses accounting standards other than GAAP or IFRS, Form 20F must discuss major differences between the accounting principles used and GAAP and provide a table that reconciles net income as reported to U.S. GAAP net income. In addition, substantive balance sheet and cash flow items that differ from U.S. GAAP must be reconciled. Canadian companies file their annual reports prepared under IFRS using Form 40F. Form 8K is required by the SEC for a wide range of events and must be filed within 4 business days of events, such as those that are shown on the slide. Other information sources include sell-side analyst reports that are provided to clients with objective analysis of company operating activities. Frequently, these reports include a discussion of the competitive environment for each of the company's principal product lines, strengths and weaknesses of the company, and an investment recommendation, including financial analysis and a stock price target. Several firms provide credit analysis that assists potential lenders, investors, employees, and other users in evaluating a company's creditworthiness and future financial viability. Credit analysis is a specialized field of analysis, quite different from equity analysis. These firms issue credit ratings on publicly issued bonds as well as on firms' commercial paper. A number of data services companies supply financial statement data in an easy-to-download spreadsheet format for a fee. Both GAAP and IFRS use accrual accounting to prepare financial statements. Although there are vastly more similarities than differences, there are some notable differences between them. First, IFRS balance sheets list assets in reverse liquidity, so that the least liquid asset, normally goodwill, is listed first, and the most liquid asset, cash, is last. The same is true for liabilities. There are also several detailed presentation and measurement differences that are highlighted in other modules. The most visible difference in the income statement is that GAAP requires 3 years of data on the income statement, whereas IFRS requires only 2. Another difference is that GAAP income statements classify expenses by function and must separately report cost of goods sold, whereas IFRS permits expense classification by function or by type. This means, for example, that there is no requirement to report a cost of sales figure under IFRS. This is the end of the presentation for Module 2, Part 2.